Australia offers a significant premium in terms of yield, and at the moment distribution and cash return is pretty high up investors' list of requirements as opposed to capital growth. There are a number of core markets within APAC where investors are more focused on deploying capital and accessing rare opportunities, especially for trophy assets, as opposed to trying to renegotiate pricing and or seek discount. So the bulk of the volume sits within a couple of transactions, namely within the core market. So I think that is probably a more kind of isolated short-term response. There will be an element of kind of investor caution around a number of deals, but we're now in a market or a cycle where uncertainty is the new certainty. So I think investors are starting to realize that they still need to deploy capital despite the kind of macroeconomic situation, and therefore it's a case of choosing the best alternative rather than just completely sitting on your hands and not deploying any capital.
Taking on the themes that Dan just talked about, I think from a domestic perspective, income durability and also exit liquidity is very important from investors, particularly in these times of uncertainty. This could be the new norm.
Over the last couple of years, we have been moving back towards a more standard deployment cycle where investors have strategic aims where they want to deploy capital into certain sectors. So I think there's an element of positivity in the market. There will undoubtedly be a little bit of a pause, and investors will want to see a reaction in terms of additional risk within the markets, given the current uncertainty.
Even though Australia is somewhat insulated from a lot of the global crises currently happening, we need to look through the cycle and stick to the property fundamentals of a long-term asset class.
I'd add to that investors have had to become slightly more flexible in terms of the way that they underwrite assets and the way that they think about medium to long-term performance. And over the years, we've seen some investors being very rigid around IRRs and very rigid around fixed underwriting periods. The reality is over the last 5 to 10 years, the volatility within the market has taught us that you can't always time your exit perfectly. People focusing a little bit more on cash distribution and income return, which gives them a little bit more flexibility in terms of that exit profile and exit timing.